Attention! What if I told you that gold could skyrocket to $10,000 per ounce and silver could explode to $200 within the next 2 years? Legendary financial expert Jim Rickards just dropped a bombshell prediction that's sending shockwaves through the investment community. While Wall Street sleeps on precious metals, Rickards warns we're standing at the edge of the biggest wealth transfer in modern history, and most people have no idea it's coming. Here's what's terrifying. According to Rickards, we're not even close to the peak. The factors driving gold and silver prices higher are just beginning to accelerate. Central banks are hoarding gold at record levels. The dollar's dominance is crumbling. Inflation isn't dead, it's hibernating. And the geopolitical powder keg? It's about to explode. But here's the kicker. This window of opportunity won't stay open forever. Rickards reveals the 3 critical catalysts that will propel precious metals into the stratosphere, and why the smart money is already positioning themselves right now. Important disclaimer, this is purely educational content for informational purposes only. This is not financial advice, and you should always consult with a licensed financial advisor before making any investment decisions. In this video, I'm breaking down Rickards' entire thesis, the timeline for these explosive moves, and what everyday investors need to know before it's too late. If you're ready to understand what could be the investment opportunity of the decade, smash that like button, and let's dive in. So let's get right into this, because what Jim Rickards is predicting is not just another hot take from a financial analyst trying to get headlines. This is coming from someone who has advised the Pentagon on financial warfare, worked with the CIA on economic threats, and has been inside the rooms where global monetary policy gets decided. When Rickards speaks, the people who control trillions of dollars listen. And right now, he's saying something that should make every single person paying attention to their financial future sit up and take notice. Gold at $10,000 per ounce, silver at $200. These aren't just random numbers thrown out for shock value. Rickards has built his entire prediction on a foundation of monetary policy analysis, historical precedent, and geopolitical realities that are unfolding right before our eyes. And here's what makes this so urgent. He's not talking about some distant future decades away. He's talking about 2026. That's barely 2 years from now. The clock is already ticking. Now, I know what some of you might be thinking. You've heard bold predictions before. You've seen headlines promising massive returns on this investment or that asset. And you're right to be skeptical. The financial media loves to sensationalize everything. But this is different, and I'm going to show you exactly why over the course of this video. We're going to dig deep into the actual mechanisms that Rickards believes will drive these prices, the historical patterns that support his thesis. And most importantly, what this means for regular people trying to protect and grow their wealth in an increasingly unstable economic environment. Let's start with the foundation of Rickards' argument, because understanding this is crucial to grasping why his predictions aren't just optimistic speculation. At the core of his thesis is something called monetary debasement. This is a fancy term for a very simple concept. When governments print too much money, the money you already have becomes worth less. Not worthless, but worth less. It's a subtle but devastating distinction that plays out over time in ways most people don't recognize until it's too late. Think about what's happened over just the past few years. During the pandemic, central banks around the world unleashed unprecedented amounts of monetary stimulus. The Federal Reserve's balance sheet exploded from around $4 trillion to nearly $9 trillion at its peak. The European Central Bank followed similar policies. Japan has been doing this for decades. China has been managing its currency in ways that create massive distortions in global markets. This isn't conspiracy theory stuff. These are facts you can verify by looking at any central bank's publicly available data. When you create trillions of dollars out of thin air and inject them into the financial system, that money has to go somewhere. Initially, it inflated asset prices. Stocks went up. Real estate went up. Cryptocurrencies went parabolic. But here's the thing that Rickards keeps emphasizing. You can't print your way to prosperity. You can create the illusion of wealth for a while, but eventually, economic reality reasserts itself. And when it does, people start looking for real assets. Assets that can't be created with a keystroke. Assets that have maintained value across thousands of years of human civilization. Gold and silver are the ultimate forms of real money. This isn't just tradition or superstition. It's about the fundamental properties that make something function as money. Gold is durable, divisible, consistent, rare, and most importantly, it can't be created at will by governments. Every ounce of gold that exists had to be pulled out of the ground at great expense and effort. You can't debase gold. You can't inflate its supply by 30 or 40% in a single year. This is why, throughout human history, gold has been the ultimate store of value when paper currencies fail. Rickards points out that we're seeing something remarkable happening right now in global gold markets. Central banks, the very institutions that are supposed to have confidence in paper currencies because they issue them, are buying gold at the fastest pace in decades. China has been accumulating gold reserves aggressively. Russia has been converting dollar reserves into gold. Poland, Hungary, Singapore, India, Turkey, the list goes on. These aren't small players making symbolic gestures. These are major economic powers fundamentally restructuring their reserve positions away from dollars and into gold. Why would they do this? Because they see what's coming. They understand that the current monetary system is unsustainable. The United States has over $34 trillion in national debt, and that number is growing by roughly $2 trillion per year. There's no plan to pay this down. There's no political will to make the tough choices necessary to balance the budget. Both major political parties have abandoned any pretense of fiscal responsibility. This means the debt will continue growing until something breaks. When sovereign debt reaches levels where it can never be repaid through normal economic growth and taxation, governments have historically chosen one of three paths. They can default outright, which destroys their credibility and access to capital markets. They can implement severe austerity, which causes massive social unrest and political upheaval. Or they can inflate the debt away by devaluing their currency. Guess which option governments always choose? They inflate, every single time. It's the politically easiest path because the costs are hidden and distributed across the entire population over time. This is where Rickards' $10,000 gold prediction comes into focus. He's not saying gold is going to become more valuable in real terms. He's saying the dollar is going to become less valuable, and gold will reflect that change. If you adjust historical gold prices for real inflation using honest metrics rather than the manipulated government numbers, gold should already be trading well above $3,000 per ounce. The fact that it is not yet tells Rickards that we are still in the early stages of this monetary reset. Let's talk about silver for a moment, because the $200 prediction might actually be more dramatic than the gold forecast. Silver has unique characteristics that make it potentially explosive in a monetary crisis. Unlike gold, which is primarily a monetary metal and store of value, silver is also an industrial metal. It's used in solar panels, electric vehicles, electronics, medical applications, and countless other technologies. This means silver faces supply constraints that gold doesn't experience to the same degree. The silver market is also much smaller than gold in terms of total dollars invested. This creates what traders call a liquidity squeeze potential. When large amounts of capital try to move into a relatively small market, prices can spike dramatically. Rickards believes that as gold rises and more investors look to precious metals, silver will attract disproportionate attention because it offers more leverage to the underlying monetary trends. If gold goes up by a factor of 3 or 4, silver could easily go up by a factor of 10 or more. The historical gold to silver ratio has varied dramatically, but in times of monetary stress, silver often outperforms gold on a percentage basis. There's another factor at play here that Rickards discusses extensively in his work: the death of the petrodollar system. For 50 years, global oil trade has been conducted primarily in US dollars. This created automatic demand for dollars worldwide because every country needed dollars to buy energy. This system has been one of the key pillars supporting dollar dominance and allowing the United States to run massive trade deficits without immediate consequences. But that system is crumbling right before our eyes. Saudi Arabia, the linchpin of the petrodollar system, is now accepting yuan for oil sales to China. They're discussing broader arrangements with multiple countries to trade oil in various currencies. Russia, after being cut off from dollar-based financial systems, has accelerated its move away from the dollar. Even traditional U.S. allies in Europe are quietly developing alternatives to dollar-based payment systems. When the petrodollar dies completely, and Rickards believes this is inevitable at this point, the demand for dollars will collapse. All those dollars held overseas will come flooding back to the United States, creating domestic inflation that will shock Americans who have been insulated from the true costs of money printing by the global dollar system. Now, let's address something important. Some people will hear these predictions and think this is about rooting for economic collapse or hoping for disaster. That's not what this is about at all. These trends are already in motion. They're the result of decades of policy decisions that have already been made. Understanding what's coming isn't pessimism, it's realism. And more importantly, understanding these trends gives you the opportunity to position yourself appropriately instead of being blindsided when the changes accelerate. Rickards emphasizes that we're not talking about overnight changes in most cases. These are processes that unfold over months and years. Gold doesn't go from 2,000 to 10,000 in a single day, but it can easily double in a year when the right catalysts align, and then double again over the following year. Silver can be even more volatile, with moves of 50 or 100% in relatively short periods when momentum builds. The key is recognizing we're at the beginning of this trend, not the end. Let me give you some historical context that Rickards frequently references. In the 1970s, gold went from $35 per ounce to over $800 at its peak. That's roughly a 2,300% gain in about a decade. Silver went from around $1.50 to $50 at its peak. That's over 3,000%. Now, those were different economic circumstances in some ways, but the underlying dynamic was the same: loss of confidence in paper currencies due to inflation and monetary mismanagement. We're facing similar dynamics today, but on a much larger scale because the amounts of money created are exponentially larger than anything seen in the 70s. What makes the current situation potentially more explosive is the level of interconnection in global financial markets. When things start to break, the contagion spreads faster and more completely than ever before. We saw a preview of this in 2008 when the subprime mortgage crisis quickly spread throughout the entire global financial system. But 2008 was ultimately a debt crisis that central banks were able to contain by printing money and bailing out institutions. The next crisis will be a currency crisis. You can't solve a currency crisis by printing more of the currency that's losing confidence. This is why Rickards sees gold and silver as essential hedges that every portfolio should include. Let's talk about some of the specific catalysts that Rickards believes will drive prices higher in the near term. First, there's the ongoing geopolitical fragmentation of the world. We're moving from a unipolar world dominated by the United States to a multipolar world where power is distributed among several major players. This transition is never smooth. It involves competition, conflict, and uncertainty. In uncertain times, gold has always been the safe haven asset that investors and nations turn to. The conflict in Ukraine and the sanctions imposed on Russia have had profound effects on how countries think about their reserve assets. If the United States can freeze or seize the dollar reserves of countries it's in conflict with, then holding dollars becomes a strategic liability for any country that might potentially be at odds with U.S. foreign policy. This has accelerated the trend toward de-dollarization and diversification into gold. China, Russia, and many other nations are now highly motivated to reduce their dollar exposure, and this motivation isn't going away regardless of what happens with any specific conflict. Second, Rickards points to the inevitable return of inflation. Many people see that inflation rates have come down from their peaks in 2022 and think the problem is solved. But Rickards argues that the structural factors driving inflation are still in place. Supply chains are permanently changed. Deglobalization is increasing costs. Energy transitions create bottlenecks. Labor markets are tight in many developed countries. And most importantly, governments haven't addressed their debt problems at all. They've just temporarily paused adding new spending. The moment any economic weakness appears, the pressure will be enormous to launch new stimulus programs, which will reignite inflation. When inflation comes back, and Rickards is quite confident it will, investors who got burned buying bonds that subsequently lost value will be much more hesitant to trust fixed income assets. They'll look for alternatives, real assets, commodities, and especially precious metals. This could create a stampede into gold and silver that pushes prices far beyond what fundamental analysis would suggest, simply because of the momentum and fear driving investment decisions. Third, there's the issue of physical supply versus paper claims. This is something that really concerns Rickards and other precious metals experts. The vast majority of gold and silver trading happens in paper markets, futures contracts, ETFs, and other derivatives. For every ounce of physical gold or silver, there are potentially dozens or even hundreds of ounces of paper claims on that metal. This works fine as long as most people are content to hold paper. But if confidence breaks and people demand physical delivery, the system could face a serious crisis. We've already seen stress in these markets during periods of high demand. Premiums for physical gold and silver coins and bars have spiked well above spot prices. Delivery delays have stretched from days to weeks or even months. Rickards believes that a true run on physical precious metals would expose the fact that the price suppression that's occurred through paper markets has created a massive disconnect between paper prices and physical reality. When that disconnect resolves, prices would have to rise dramatically to clear the market. Now, I want to address something for those of you who are newer to thinking about precious metals. You might be wondering why you should care about gold and silver when you could invest in stocks or real estate or other assets. This is a fair question, and the answer comes down to portfolio diversification and understanding the different roles various assets play. Stocks are great when economies are growing and corporate profits are rising. Real estate works well when credit is abundant and populations are growing. But both of these asset classes are highly dependent on the continuation of the current financial system functioning relatively normally. Gold and silver are insurance. They're what you hold for the scenarios where the normal rules break down. They're not about getting rich quickly. They're about preserving wealth across time and through different economic regimes. Rickards recommends that most people hold at least 10 to 20% of their investable assets in physical precious metals. Not mining stocks, not ETFs, but actual physical gold and silver that you can hold, or that's stored in secure, allocated storage where you maintain ownership. The beauty of this approach is that if Rickards is wrong and the monetary system continues functioning without major disruption, you haven't lost everything. Gold and silver maintain value. They might not keep up with a roaring stock market, but they don't go to zero. However, If Rickards is right, and we see the kind of monetary disruption he's predicting, that 10 to 20% allocation could end up being worth more than the rest of your portfolio combined. It's an asymmetric bet, where the downside is limited but the upside is substantial. Let me share something else that Rickards emphasizes in his work. The transition to higher gold and silver prices won't be linear. There will be periods of consolidation, pullbacks, and even sharp corrections that shake out weak hands. The path from $2,000 to $10,000 gold will likely include drops back to $1,800 or $1,500 at various points. This volatility scares many investors, but it's actually normal and healthy for these markets. The key is understanding the long-term trend and not getting shaken out by short-term noise. This is where having a plan becomes crucial. If you decide that precious metals deserve a place in your portfolio, you need to determine your allocation, make your purchases, and then have the discipline to hold through volatility. Dollar cost averaging can be an effective strategy here, buying a fixed dollar amount regularly rather than trying to time the market perfectly. This smooths out your entry price and removes the emotional component of trying to pick exact tops and bottoms. Looking at the timeline Rickards proposes, 2026 might seem aggressive for such dramatic price moves, but consider how quickly things can change when tipping points are reached. In early 2020, almost nobody predicted we'd see the kind of monetary expansion and inflation that emerged over the following years. In early 2008, most people thought the financial system was sound. Major changes often happen faster than anyone expects because markets move at the speed of information and emotion, not at the measured pace of academic forecasts. Rickards has been consistently ahead of major market moves throughout his career. He predicted the 2008 financial crisis. He warned about currency wars and competitive devaluations years before they became mainstream concerns. He's been talking about the fragility of the financial system and the inevitable return to gold-based monetary thinking for over a decade. His track record gives his current predictions significant credibility, even if the specific price targets and timeframes might be subject to some variation. What I find most compelling about Rickards' analysis is that it is not based on hope or speculation. It's based on understanding how monetary systems work, how they fail, and what happens afterward. Throughout history, every purely fiat currency system, meaning currencies backed by nothing but government decree, has eventually failed. The average lifespan of a fiat currency is around 27 years. The current dollar system, divorced from gold since 1971, is already well past that average. We're living on borrowed time in terms of monetary stability, and the longer the reckoning is delayed, the more severe it's likely to be when it arrives. For those of you still on the fence about whether this matters to you personally, consider this. Even if you don't own any gold or silver, you're still exposed to these monetary trends. Your savings account, your salary, your retirement accounts denominated in dollars, all of these are at risk if the purchasing power of the dollar declines significantly. Inflation is a silent thief that robs you of wealth without you even noticing until you go to make a major purchase and realize how much less your money buys. Having some allocation to precious metals is simply smart risk management in a world where monetary authorities have shown they're willing to sacrifice currency stability to achieve short-term political and economic goals. As we move through 2025 and into 2026, watch for the signs that Rickards highlights. Watch central bank gold purchases. Watch inflation data, but don't just accept the official numbers. Look at your own expenses and how they're changing. Watch geopolitical developments, especially anything related to the dollar's role in international trade. Watch the bond market, because that's where a loss of confidence in dollar-based assets will first become apparent. These indicators will tell you whether Rickards' timeline is on track or whether the reckoning gets delayed a bit longer. The bottom line is this. Jim Rickards' prediction of $10,000 gold and $200 silver by 2026 is bold, but it's grounded in serious analysis of monetary trends that are already in motion. Whether you agree with his specific price targets or timeline, the underlying message is clear. We're in the late stages of a monetary system that is becoming increasingly unstable, and precious metals offer protection that becomes more valuable as that instability increases. This isn't about fear-mongering or trying to sell you something. It is about understanding the economic reality we're facing and taking reasonable steps to protect yourself and your family's financial future. The window to position yourself appropriately is still open, but it won't stay open forever.